Hi, good evening, everyone. This is Nitin Gupta from MK Global. I would like to welcome all to Berger Paints India's Q1 FY26 result conference call. I thank Berger Paint Management for allowing us to host. We have with us today Mr. Abhijit Roy, Managing Director and CEO, Mr. Kaushik Ghosh, CFO, Mr. Sujyoti Mukherjee, Vice President Finance and Accounts, Mr. Sayantan Sarkar, GM Finance and Accounts. I shall now hand over the call to management for the opening remarks, post which we will proceed with Q&A session. Over to you, sir.
Thank you, Nitin, and good afternoon to all of you. Let's begin the presentation with a quick look at what is going on again. Can you move the screen? Yeah, right. Quick look at the quarter one results. We continue to gain market share above 20% within the listed company space. Mid-single digit volume growth was registered in quarter one. Growth was moderated by heavier than expected monsoon towards the end of May and June. PVDIT margins improved both sequentially and year on year in spite of heavy competitive pressures. Automotive segment delivered stronger volume and value growth versus overall performance and strong revenue growth in international operations. We have been consistently outperforming the industry, resulting in market share gain. These are the 5-quarter industry growth as per the results published. These are standalone results of various companies added together in the listed space. As you can see, the growth rate has been for the industry has been minus 0.9, minus 3.3, minus 4, then it went up to minus 1.2, and this time for the first time it is positive at 0.3% for the existing listed players in the industry, the 5 players which are there. And if you look at our performance against that, we have been at 2.4 minus 0.4 plus 0.4 plus 4.4 and then again at 2% this time. So consistently above the industry level. As a result of that, we have been gaining market share in spite of intensifying competition. 18.9 to 19.3 to 19.5, then on to 20.3 and 21.2. This is the market share as per the standalone results which have been declared by the companies over the years and in this quarter. However, if you add Birla and assume that they would have gained about 5.5 to 6% share, then too our market share stands slightly above 20% and we remain at that level. In fact, we have been gaining market share even with their presence continuously. Now, if you look at the top line growth, which we registered this quarter, standalone basis, 5.6% volume growth and 2% value growth. The decorative segment delivered mid-single digit volume growth. The volume value gap narrowed, driven by improved mix and waning impact of prior price corrections. Strong traction in roof cool and seal, home shield range of products, and wood coatings. Protective and automotive coatings maintained positive volume momentum. GI and powder coatings performance remained subdued. If you look at the gross margins, it's been very stable and across quarters, in spite of increased competition, it's been hovering in that range of 39 to 41. This quarter too, it was 40.1%. Against year on year, if you compare against quarter one of last year, which was at 39.3, it's an improvement. There is a slight dip from fourth quarter of last year from 41.2 to 40.1. This dip is explained by adverse mix impact. Due to excessive rains, there was a little bit of a less sale of exterior emulsions, and also the luxury interior emulsion sales was down a bit compared to fourth quarter of last year, and therefore slight dip there that you see. However, against quarter one of last year, there is an improvement from 39.3 to 40.1. On the operating profit side, however, it's all positive. In fact, it has been steadily gaining ground from quarter two of last year. If you look at it from 15.8, it moved up to 16.2, then further to 16.6. And in this quarter, it has gone up to 17.4%, which is an improvement over quarter one of last year, which was at 17.2, and also against quarter four of last year, which was at 16.6%. So, margin resilience is driven by stable gross margins and operating leverage from fixed costs, which we have been able to control and reduce, and improved utilization at the Sandila plant. Last time, if you recall, we had initiated the Sandila plant and we were burdened with extra load of that plant. And we had mentioned that, we will improve on this as the things go forward. And so that has helped us to improve our overall profitability, operating profit ratio. In terms of results, if you look at it, 2% is the sales growth rate, PBDIT standalone, PBDIT growth rate 3.3%, profit PBIT at 5.1, PBT before exceptional item is 5.3%. There is an exceptional item of 36.8 crore. This is an unfortunate fire incident which happened in our warehouse near Kolkata in Barasat. There was one other warehouse nearby which caught fire. From there, the fire spread to another warehouse which was adjacent to us, which was a Hitachi warehouse. The ACs burst into flames, and the flame leapt into our warehouse, and our warehouse got gutted completely. Of course, it's fully insured, and therefore insurance process is on. So that's an exceptional item of 36 crores, which is why you see a negative there in terms of PBT and PAT. But otherwise, without that exceptional item, we would have registered a growth in PAT of around 5 point something percentage. As far as the 3-year, 4-year, 5-year results are concerned, you can see the CAGR 3-year, which is 10, 4.8 and 10.2 in terms of volume, value, and net sales and PBDIT. If you take 4-year, volume growth is 16.8% CAGR, net sales value growth 15.3%, and in terms of PBDIT growth, it is 22.6%. And 5-year CAGR 26.3, 28.2, and 34.5%. On a consolidated basis as well, it is a similar trend line for 3-year, 4-year, and 5-year. Quite robust 4 and 5-year figures. It's just that, the last 3 years, especially the last 2 years, as you are aware, there have been price drops as a result, plus there has been a slowdown and the intensification of competition, which has squeezed the volume value growth a little bit, but still at a reasonable level. At 3-year levels also, we are in a standalone basis 10, 4.8 and 10.2. Strong performance sustained, led by anti-dust, long life, and Silo Prime. Construction chemicals and waterproofing delivered robust volume value growth with stable margins. Roof Cool and Seal further picked up momentum. Wood coatings posted robust volume and value growths. Store footprint expanded by over 300 during the quarter, taking the total count to 1300 plus stores as on date, underscoring continued retail network growth. Tinting machine installations over 2500 plus for the quarter. So we are well on course to add 10,000 plus more machines for the year. We introduced a product called Color Plus in this quarter. It's an interior premium emulsion, matte finish. We had Easy Clean, which is a clear leader in that segment. But that's a little bit of shine which is there on the wall. People wanted a matte finish as well. And this is a new product category which we have introduced called Color Plus. Doing reasonably well so far. The momentum is picking up across. We have launched it initially in the south, and now we will be expanding it across the country. Walls that wow, European technology, washable color guard with 6 years of warranty, premium emulsion in the matte finish category. We of course continue to advertise. The new ad has been released called Nothing Shines Like Silk for Silk Glamour with Karina there. Easy Clean continues to do well in the market across markets. Of course, we also introduced another new product called Luxol Metallics. This is a solvent-based metallic range, silver, gold, copper, which is picking up in this country. And we thought that this segment was missing, and we introduced it in this quarter. It is a lustrous metallic sheen, PU enriched with 4 years of warranty. We had introduced, if you recall, I had spoken about anti-dust cool, which is, earlier we had introduced this. We had introduced last quarter roof cool and seal last year. It did quite well the whole of last year. This year it continues to do even better. And we introduced a new product this year called Tank Cool for the water tanks on the rooftop. All of these three products for the summer months, it is a very useful range of products. Anti-dust cool for the body, roof cool and seal for the roof, and tank cool for the tank. And we advertised across newspapers this entire cool series. As you can see, the house wearing a jacket, that you need not worry about the summer heat. Even in the summer heat, the temperature goes down by 8 to 10 degrees centigrade, making you feel much more comfortable. In terms of consolidated sales, top line value growth at 3.6%. Operating profit is impacted due to margin pressures in Bolix's UK operations, essentially because of the project, one of the projects where the cost due to time delay, went ahead of revenue, and therefore there was some pressure on the profit there. Joint ventures delivered strong performance in both revenue and profitability. Consolidated results, as you see it, 3.6% value growth, 1.1% operating profit growth. And then, of course, the two exceptions. One is the Bolix cost overrun, and the second one is the exceptional item, the fire, which pulls down the profit in the PBT and PAT range. BJ and Nepal outperformed within the group, delivering strong revenue growth and margin expansion. Wholly owned subsidiary Bolix reported a stable quarter in revenue. However, muted margins in UK operations, as I mentioned, impacted overall Bolix group profitability. STP and SBL coatings saw flattish growth, weighing on overall profitability due to scale challenges. Berger Rock continued to post solid performance. This is our auto refinish joint venture with Rock Paints of Japan in both revenue and profitability growth. The joint venture BNPA, which is Berger Nippon Paint Automotive Coatings, which is focused on the automotive, four-wheeler, car and passenger car and SUV business, delivered robust growth in revenue and profits, driven by higher OEM sales in the automotive segment, along with some good business in some of the new accounts like Kia, etc. Berger Becker joint venture also witnessed a strong turnaround post fire related losses, aided by improved product mix and margin recovery. How does the business outlook look like for the rest of 26? Gradual improvement in demand indicators observed with early momentum in urban markets, well progressing monsoon and easing inflation may support rural sentiment under a supportive policy environment, market competitiveness to stay elevated, continued thrust on innovation and brand distinctiveness to navigate short-term challenges, potential pickup in government infra spending in the latter half of the year could aid growth momentum and broaden economic activity. Currency volatility, ongoing tariff wars, and evolving geopolitical tensions remain key risk factors. Thank you, and I'm stopping here and opening up for questions.
Thanks, Abhijit. So we will now start with the Q&A session. I hand over to my colleague Bhavik Shankalesha to moderate the Q&A session. Over to you, Bhavik.
Those of you who have the questions can raise your hands now. We will announce your name and unmute your line. Please highlight your full name and the organization you represent. The first question is from the line of Mihir Shah. Please go ahead.
Hi, sir. Thank you for taking my question. This is Mihir Shah from Nomura.
Hi,
Uh,
Mihir.
Hi, sir. Firstly, congrats on better than peers volume growth number and continued share gains. So, firstly, on volume growth, I wanted to check, the while you've done better, but we were expecting a little bit of improvement versus the number that we have seen of 5.5%. We were expecting maybe closer to high single digit volume growth. Um, so on this front, basically, can one expect this growth that has not come to be deferred in the coming quarters? And should we expect a better volume growth in the coming quarters? Any signs or indication that you're seeing of this to continue to improve apart from the sales that we lost this time around?
So typically, Mayor, sales do come back, because the monsoon is unpredictable. It's difficult to guess in India, when it will come and how long it will prevail. So it started a bit early this time in towards, end of May, which was a surprise, across many markets, and it was quite intense in some parts of the country. So May and June, as a result of that, normally in paint it gets postponed. July also was quite heavy. But once it abates, we have always seen that the sales tend to come back. So we would expect that sales will come back once the monsoon abates.
So fair to say, an indication from your side would be helpful. Fair to say a high single digit can be expected in coming quarters because of this deferment, plus any further improvement that you are seeing in the market, or that is giving you confidence that that there's the low volume phase that we have seen is kind of behind.
So, if you ask me, my expectation is that once the rain stops, it should go up. But if you are asking me whether I'm seeing any indication immediately, so far, we haven't seen anything which indicates that, substantial improvement in volume, growth momentum will be there. However, once the rain stops, it is expected that, the volume momentum should pick up.
Got it. That's very clear. Thank you for that. Second question is on competitive intensity. It seems other players have highlighted that the dealers lost to competition are now coming back. Wanted to know your thoughts on how this is shaping up for you and any other trend that you are seeing in the marketplace with respect to competition, etc.
So frankly speaking, competition, as I had already always maintained, there will be some share loss, which is likely to happen for all the players, which we have seen happening in the recent past, right? Because any new player who comes in will gain some share, and that will be at the cost of the existing players. Otherwise, we would have got that share. So from that perspective, there has been some loss. As I said also last time that for the past few months we feel that it has become it's not increasing in terms of intensity. it is stabilized at those levels. So I won't say that dealers are coming back, but the initial euphoria is over completely. That's gone. That initially that curiosity, the enthusiasm that was there, something new, something great is happening. That is completely gone now. Now is the time when people start realizing that it is not very easy to get additional margin. So what was happening was, there was a competitor which was discounting heavily, and the dealers were selling at a price which was similar to ours in the marketplace initially, and therefore they were pocketing that differential in their pocket. But once with the network expansion happening heavily and interdealer competition increasing, that margin of profit has reduced considerably. And as a result of that, there is a little bit of a loss of interest from the dealers. And hence, people might be feeling that, some of these dealers might be coming back to the legacy companies with whom they have been dealing in the past. Because once they see that there is no great margin and the movement of the product is nothing great so far, then they feel that why should we be pushing this so aggressively. So that's a normal behavior expected out of any newcomer who enters, initially gets in and then stabilizes at some point, and that's what is happening now.
Got it. Thanks for your thoughts, sir. Always very helpful. Lastly, if I can just push in one more on margins, you continue to maintain the margin guidance band that we highlighted. I assume that there's no change out there, right?
No, not at all. You have seen that we have, in fact, always said that it will be operating in the 15 to 17% range. We have been more or less towards the 17. In fact, in the standalone, we are ahead of 17%, but we are around that point only.
Got it. Wishing you all the very best, sir. Thank you very much. That's all from my side.
Thank you.
Thank you. Next question is from the line of Avi Mehta. Please go ahead.
Yeah, hi, sir. Am I audible?
Yes, you are, Avi. Go ahead.
Sir, hi. This is Avi Mehta here from Macquarie. Sir, I had two questions. You've clearly indicated about the margin, comfort, but I just wanted to also check: would given this demand environment, would we still want to say that we would gun for a low double-digit volume growth in the next year, or the demand environment? How do you see that? If you could give us some clarity on that expectation, that would be useful. And second, sir, I wanted to check. Yes, I do understand the stabilization of competitive trends, but would love to hear your thoughts on how do you see this intensity behaving now that there has been another merger between Axo and JSW.
Right. So as far as volume, trend you have seen, that we have been hovering around this, 5-6% to 7-8% range. The whole of last year we were at around, on average, around 8%. And last quarter four of last year also, we were around that same point of 8 to 9% in terms of
Yes.
volume. This quarter has been a little bit lower than that at about 5.5%. We expect that once the rains are over, to go back to that 7, 8, 9% range initially, and maybe even better as the year progresses. So this is something which we feel that should happen. Now, as far as competitive intensity is concerned, I have explained about the first player, which is who entered initially, and the second, which you mentioned, JSW plus Axo, that's still not formalized sort of. They have to first of all merge, or do something, or if it is standalone, if they operate just like they are doing today, I see no great changes happening in the competitive intensity. Yes, there is some change which is likely to happen, the change in ownership. There might be, some amount of advertisement which will go up, some spending increase possibly. But overall, I don't see any major tangible change. Both these players have been existing in the Indian market for a long time. One which is almost equal to us, in number of years, and the other which has been there for 5, 6, 7 years now. So I don't see any significant change in competitive intensity emanating from this change that has happened.
Very clear, sir. Very clear. And sir, if I may just follow this up from a growth perspective, what you're expecting, sir, I mean, how do we see the demand trends? Wanted to get your thoughts. It's been now 3 years where growth has been weak. We are still, expecting that the relationship with GDP will come back. But what do you think went wrong that this situation has arisen in the first place? What would be your thoughts on that?
So nothing went wrong away. In fact, it's a mistaken notion that
Oh, okay, sir.
there has been a great demand shrinkage. In fact, till
Yeah.
22, 23, we had a very good year. In fact, 23, 24 was reasonably okay. So you can say it's not a 3 year phenomenon. It's a sort of a 24, 25 has been an issue, and 23, 24 second half was an issue. So it's about 1.5 years where the growth has been lesser. And a large part of that reason is, that the volume growth has been there, but the value growth has not been there because there was a price drop of almost, 5, 6%, right? So when you have whole of last year, we were fighting against this price drop of 5, 6%. Then a new player had come in. New player had come in and it had taken 3.5%. So if you have 5, 6% of price drop and 3.5% going to the new player, so that accounts for 8.5%. In spite of that, we did register a growth of about 4.5% last year. So if you add back this 8.5 to the 4.5, it would have been 13% growth. So that's why I'm saying it is not that the growth rate had come down. It's just that the price drop impacted significantly last year, and the intensification of the competition, who took away about 3.5%, overall impacted everyone to that extent. Some may be 5%, some may be 3%, but overall there was an impact for every player. Obviously, because when the consumers are going to another brand, that brand otherwise would have, that consumer demand would have come to us otherwise. So that much of share loss has happened for everyone, right? So overall industry, if you look at, even this quarter, it has grown, the industry, the legacy players has grown by approximately around, say, 0.5%. And Birla would be sitting at around 5.5 odd percentage to 6%, right? So overall, the industry's growth is 6.5%, which is not very bad in terms of the value sales. The overall consumer demand itself has been lesser, compared for all categories. It is not only paint, any type of consumer category. There has been a bit of a slowdown there. So instead of 6.5, it would have been under normal circumstances 8.5, 9, 10 maybe. So that slowdown of 3, 4% is there in the consumer sentiment because of inflation, because of other issues, which is progressively improving. So that is why we are hopeful that in the second half there will be, a good improvement overall that you see from the current levels.
Got it, sir. Got it. Very, very clear, sir. Very clear. Thanks a lot. I have some other questions, but I'll come back in the queue. Thank you very much, sir.
Sure. Thank you.
Thank you, Avi. Next question is from the line of Tejas Shah. Please go ahead.
Hi, am I
Hi,
audible?
Tejas.
Yes.
Yeah, thanks. Hi, sir. This is Tejas from Avendus Park. Sir, you broadly touched upon competitive intensity, and you have been very fairly consistent and honest on this.
Can you be a bit louder? I can't hear you.
So, am I audible? Hello?
Yeah, now you are.
Yeah, sorry. No, I said that you broadly touched upon competitive intensity and you have been fairly consistent in that. Just wanted to understand, is there any more nuanced dimension to it in terms of premium economy or mass? Is it like varies a lot in terms of the segment of the market?
So, frankly speaking, not so much. It is there more towards the economy, the primers, and lesser towards the luxury or premium luxury category. So mostly the commodity type where the first it expected as well that where lesser branding strength is required, that is the place where one tends to have some sort of erosion initially. So that's where it is getting impacted first. And probably, most companies would be reacting in that space also and ensuring that that is taken care of. So, uh, from the perspective of, otherwise there is no other major uh, mix change we would have seen, observed uh, any particular peculiarity in the way it has been impacted by the competitive intensity.
Perfect, sir. And sir, any regional nuances worth highlighting? And also, uh, are they or the competitive intensity has become much more aggressive or equal in project business versus the rest?
I can't hear you properly, Tejas.
Hello. Yes, sir.
Yeah.
Yeah. No, I was asking, is there any regional nuances worth highlighting, and also any different any comments to make on project business versus the rest on the same parameter?
No, not really. Project business, no, nothing, which is worth mentioning. And even in the regional nuances, nothing which is extraordinary. It is more or less similar in nature across most regions. Possibly in the south, there has been, slightly higher intensity of competition than the rest.
Okay. And so last one, if I may, uh, given that most of the paint companies flagged weak demand in June, July due to early onset of monsoon, how would you assess the current inventory levels in the trade channel? And why am I asking this is that do you foresee some pressure on margins? Let's say because there is a lot of stocking up which would have happened because of early monsoon this year.
Uh, so, Tejas, normally in the paint business, when we are selling, we have to collect also, otherwise, sales get stuck immediately, right? Uh, that is why the sales figure and the growth has been less. So, the channel inventory is fine. I don't see that, getting impacted in any significant way. Uh, Unless they pay, the channel inventory clears, then they pay, and then we again sell, the cycle doesn't move. So there is no great impact there as far as the channel inventory is concerned, and therefore it is normal business at this point of the year. Normally it rains, it's a monsoon month, it is expected to rain, and every year we go through the same situation, so I don't see any major change there.
Perfect, sir. As always, very helpful. Thanks and all the best.
Thank you. Next question is from the line of Abnish Roy. Please go ahead.
Yeah, thanks. So firstly, congrats on continued faster growth. One is on Bolix. Any timelines you see in terms of recovery? It's a mature market where multiple factors are in play in terms of low growth, geopolitical tensions keep happening. What will be the long-term strategy in a Bolix kind of a business, given the developed market where it is?
So actually, Avnish, this Bolix business, as we see it, it's on a good wicket as of now, largely because it is in a domain which is basically meant for energy saving. As you know, this is a insulation business, and in Europe and UK, the governments are promoting this, in order to save energy, with the geopolitical situation being as is, and with Russian oil not being there for them, which has become expensive for them, gas and other energy costs, they want to save on the energy cost. So it's a category which is actually growing. We had a little bit of an issue in the UK operations with two of our projects which are there, where there was a delay. Actually this delay has been going on for some time now, because of other regulatory issues which cropped up there, which is getting tackled. But unusual, unnecessary losses because of the time delay which happened for us. But it was not within our control, because the regulatory changes happened suddenly, and we had to, change our entire strategy for these projects. But this is just a temporary phenomenon. It will go away, and overall the business is very healthy and it is looking quite promising now.
Sure. My second question is back on the Indian deco market. So the market leader has been highlighting one or two things in the last 2 quarters. One is, of course, a regionalized product strategy, which FMCG companies like Unilever, Nestle have been doing, winning in many India, kind of a concept. So wherein for a few states, you have a specific product packaging targeting that. Similarly, one more thing which they have been doing last maybe 2-3 quarters is 4-year warranty. Have you also responded with a similar kind of strategy? And does this help in overall market dynamics?
So, Avnish, India, as you know, has different tastes across different regions, and therefore product mixes are different in different locations. It is tailored in that direction. We don't have the type of container design or, specific to a region that you are talking about. I don't think that is required as well so much. Yes, it aligns well with the consumers possibly, but more importantly, the type of products that sell in particular regions are what is of greater importance, and tailoring our products and the pricing for that region becomes very critical. Therefore, we always do that. It is an important way of, and even the advertisements, the way you communicate, everything changes from different states and different regions in India. It's not a single country, where you can advertise one thing and communicate, so everything, the product, the pricing, the promotion, all the P's are, except for the distribution strategy, which is quite, similar across regions. Everything else tends to change depending on where you are within the country. So that has to be done. If you really want to do well, if you're an all India player, you will have to keep doing this.
Understood. One more question on the India competition, Deco. To be fair, you have been the most candid, transparent, and frankly commenting on competition on national media interview. I think it's a commendable thing. And you said a few months back that new player last 3-4 months, it's a stagnant sales. Now we are seeing other players, legacy players, also talk more confidently. My specific question here is, you said initial euphoria among dealers is completely gone. Specific question here is, how is the initial euphoria in the painter and influencer now versus the first 6 months? Here also, has it kind of evaporated? And 10% extra grammage by the new player. We got in another call today that maybe in some areas it is reversing. Now these are early data points. What are you picking up on the 10% extra grammage?
So, the 10% extra grammage, there has been reduction there. I am told that, earlier it was across all pack sizes. Now it's there primarily in the 20-liter pack sizes. The 1 and 4-liter possibly has been withdrawn in, many markets. That's the news which is coming back to us. So there is some rationalization obviously happening in that space. Possibly, this has been, as I had always said, that, this has been tried in the past by a few other companies. It, initially gives some result, but then it, then becomes quite useless, in terms of added advantage in the marketplace, and sometimes can be at the detriment, in terms of sales growth. So therefore, I think possibly it will get slowly phased out. It's an initial entry strategy, as was indicated by them, and I think, it will get gradually phased out. So this is my viewpoint. Things have to be seen, whether this is true or whether this will sustain. One has to see that. As far as, the painter influencer area is concerned, there, so far I don't see any ebbing. That neither was there any great enthusiasm, nor is there an ebb in that. It is still, hard work in that segment. For any new entrant or even for existing players, we have to really work hard in this particular area.
And last follow-up question, sir, and I'll end there. This 5.5% market share, say for the new player, is it largely in the lower end because you who have been there for decades and have done a commendable job, still you are under-indexed in the mid and premium versus say the market leader and versus the brand which got sold. So in that context, obviously entry barriers in mid and premium are far, far higher. So would you say that this 5.5% market share is heavily over-indexed at the lower end?
So most likely, Abneesh, I don't have access to the sales data, but I would guess that that is most likely to happen. Largely because, as you rightly said, in the premium luxury segment, brand plays a far bigger role there. And it is difficult to change a customer in this particular area. However, at the lower end or at the mid-lower end, it is relatively possible with the effort of the influencers to change customer preferences, and therefore, more possibility of, the sales getting overly indexed at the initial stage in these category of products.
Thanks. That's all from me, and all the best. Thank you.
Thank you, Abnish. Next question is from the line of Karthik Chellappa. Please go ahead.
Yeah, thank you very much for the opportunity. Karthik here from Indus Capital. Am I audible?
Yes, you are.
Okay, great. Thank you very much, sir, and congrats on the quarter. So, two questions from my side. The first is, with your assessment of the way volume demand is set to recover after the monsoon season and the way mix has been evolving and the anniversation of the price cuts, at what point or in how many quarters, in your assessment, you think volume and value growth will start to converge?
So, Karthik, possibly, for the next 2-3 quarters, there will be some differential between the volume and the value growth, largely because of the mix of products, which is growing faster than those which are not growing as fast. So from that perspective, there are two categories. One is the texture coating, the other is the tile adhesives. For us, those two categories are growing at a faster pace uh, than, say, some of the other categories which are there in paint, right? So as a result of that, and these are, high volume but lesser value products, doesn't mean that they are less profitable. But they have the nature of the product is like that it is voluminous with lesser value. So such a scenario, when you look at it, and since we measure it in kg stroke liter, we all combine it together, then it looks like that the volume growth is on the higher side compared to the value, and that differential is possibly going to remain at about, say, 1.5-2%. It will narrow down further. It's already at around 3.5% now. With the growth rate jumping for regular paint, that might narrow down to 1.5 to 2%. But that differential will remain to some extent.
So conservatively speaking, the earliest we can expect, assuming if volume growth recovers to, let's say, 7 to 9%, for us to hit a high single-digit value growth, conservatively speaking, we can probably look at the fourth quarter exit of this year or possibly in early FY27.
I think, if all things go well, we can expect that the fourth quarter should be where, we can expect that, as you are saying, or early next first quarter, maybe. But we would see if all things go well, if the rains, stop and the demand should, as I expect, to come back, as it has always happened in the paint industry earlier. Then I think, third and fourth quarter, we should expect that, the value growth will come to a reasonably high level, possibly close to the, 9-10% range.
Excellent. My last question, sir, is if I were to look at the standalone employee expenses, in the last 5 quarters, barring maybe 1 quarter, that has continued to grow at double digit. What proportion of that would be, let's say, increase in feet on street versus, let's say, normal salary inflation? And is this also one of the ways in which the heightened competitive intensity is manifesting, whether in terms of retention of staff or higher payouts, etc.?
No, so it has been, we have added genuinely, feet on the street as well. But since as you see, 8 to 10% has been historically there with us. It's not as if something different is happening now. The salary increases in India, the inflation has always been in excess of 5 to 6%. So the increases has always been in the range of 8 to 9% on an average that we have given. So that's something which will always happen irrespective of what is the situation like, unless it's a sort of a disaster. So as an employee cost to sales, it tends to move up a bit, under the current circumstances when the value growth is not coming. But there's been no tangible massive increase in as far as the employee cost is concerned. The other part is, yes, we have increased the feet on the street. Not only, because the competition has come in, but because we feel there is an opportunity for us in certain markets like the urban markets where we have invested. So now that investment immediately doesn't give result. It takes a little bit of time. We are very certain that from fourth quarter of this year, we will see quite an impact as far as the urban performance is concerned for us.
Excellent, sir. One data point, if you can share, for this quarter, by how much did the A&P expenses grow year on year? Would you be able to give some color?
So there has been an increase, normal increase would have been possibly around 4 to 5% maybe on the A&P expense growth, similar to our sales growth, but a little bit higher, and which is why, the expenses would have grown at that level only. Not
Excellent. That's all.
significant, I would say.
Okay, excellent. That's all from my side, sir. Wish you and the team all the very best for the remaining quarters.
Thank you.
Thank you. Next question is from the line of Pratik Gothi. Please go ahead.
Hello.
Hi.
Hi. This is Pratik Gothi from HSBC. I have a couple of questions. Question one, so the luxury segment of emulsions, have we seen slow growth in that particular segment over the last few years? And if yes, do you think there is some down trading in that segment from, say, luxury to premium, or is there some other trend at play there? Would like it if you throw some light, please.
So, as far as luxury segment is concerned, the luxury interior segment has seen, for us, some slowdown. The luxury exterior continues to do reasonably well, so there is no fixed trend which says that luxury is moving down, shifting towards premium. As far as we are concerned, the luxury exterior continues to do quite well. The luxury interior, we are not a very strong player there, but we have pockets of strength. And in those pockets, we were a bit impacted by the excessive rains which happened, so maybe some people postponed or just changed it, or I don't know what the reason is, but there was a little bit of a slowdown in those locations. Though interior shouldn't have been impacted, exterior should have been impacted more in rains, but we see the other way around, the interior getting impacted a bit more. So that is what has happened. So I don't see any secular trend of downshift, happening from luxury to premium category.
Great, thank you. And my other question is on the industrial business. So performance has been mixed, so to speak. Is that the right way to put it? Two
Yeah,
segments have
you
been
can
good.
say that, some of the categories like the automotive did much better. On the back of, slightly lower basis, they did, good growth. Both the two-wheeler, the commercial vehicles in which we are present, and even in the joint venture which we are there with Nippon, that did very well, in fact. So overall, the auto segment did better. Auto refinish grew very well. The protective coatings volume growth was quite good, but we had to cut prices a little bit because the profitability was reasonably good and the competitive intensity was high. So therefore, the value growth was not as high as the volume growth. The powder and the general industries categories, those two had some issue with the demand itself. Primarily, the fan industry suffered a bit, and hence the GI and the powder, both of these had very muted growth.
Okay, that helps. Thank you.
Thank you. Next question is from the line of Sukrit Patil. Please go ahead.
Yes, good evening. Am I audible?
Yeah, if you can be a bit louder, it will help.
Yes, am I audible now?
Yes.
Yes, okay. So I'm a shareholder of your company, and my question is, given the exceptional loss of say 36,000 crores, 3,600 crores from the warehouse fire and the impact of the early monsoon on volume growth, how is Berger Paints strengthening its operational this thing, and uh, is there a new risk of mitigation frameworks or supply chain redundancies being built to safeguard future profitability?
So, Patek, first of all, it is 36 crores, not 3,600 crores.
Sorry. Correct. You're
That's
right.
the
You're right. Yeah.
stock inventory which we had in the warehouse. It was an unfortunate incident which was beyond our control because the fire didn't catch within our warehouse. It actually happened, quite some distance away, but that fire, engulfed some other fire, and then we were about three warehouses away from it, but all the four warehouses got burned down. So nothing that you could have done from your side. We take extreme precaution across our warehouses. We are very well equipped to handle fire. If it had happened within our unit, possibly we would have. And unfortunately, it was a Saturday evening when all the employees had gone home. There was no one to do the firefighting. In case there were some people there, we would have possibly tackled it even better, but it would have been risky that way. The fire engines came in, even they were finding it difficult to control the fire, and therefore beyond control actually. So nothing that we could have done. We too take extreme care as far as our because we are a category where this is of extreme importance. So rest assured that we have no problem there.
Okay, great. Thank you very much.
Right.
Thank you. Next question is from the line of Jay Kumar Doshi. Please go ahead.
Yeah. Hi, Abhijit sir. Thanks for the
Hi, Jay.
opportunity. I've got three questions. The first one is, competitive intensity, which you've largely answered. But very specifically, I would like to know that whether is there any change in trade schemes, working capital, credit period that the new entrant is offering to its dealer network versus what it used to be 6 months back?
No, they have been more or less, they came in with a dealer price list which was 5% lesser in terms of pricing, and schemes which were slightly higher loaded than the industry in general. But I see no major changes. The schemes have become more complicated. It was initially inbuilt scheme which was being given. Most of it used to be 80-90% loaded onto all dealers in a similar way. But now it's like any other player. It's become very challenging or complicated, I would say. So that's the only change which has happened. I see no other change which has happened from what it was there in the past.
No additional working capital credit period support in case of.
Not that I am aware of, which makes
Understood.
nothing has
Now,
come back which is of significance, I would say.
now, is there any increase in competitive response from incumbents this year, especially, any rebates or sort of schemes on putty or at economy and or in the projects business? So just want to know if, if the new entrant sort of stabilizes at 5-6% kind
No,
of market share,
not really.
would you guys actually now sort of take an opportunity to, regain some of the lost share?
So, Jay, actually, if you ask me, it is better to remain at a stable price level instead of trying to do something, because these things have their own way of stabilizing, So we have seen this happening earlier with another player, who had entered in the south, if you recall, in Tamil
I'm
Nadu.
aware.
And then they did this exactly the same thing. And when you start withdrawing the benefits to the dealers and the painters, then the sales start, coming down, and you just have to remain steady and keep growing, So there is no point trying to, because it destabilizes the rates, and then, the dealers get worked up, and then there are a lot of disturbances in the network, and that is something which is avoidable, So we follow our own policies and carry on, irrespective of what others are doing or not doing. I don't see that that we would be actually trying to do something. In fact, the gains should come back. The dealers will realize that if the momentum is not there in terms of movement of the product, and if he is not making additional margin from the newcomer, then why should he try to push that product? And why should he therefore continue in a bigger way with the new incumbent? So he tends to swing back slowly towards the existing players. So that's what has happened in the past and is more likely to happen in the future as well.
Perfect, very helpful. Second question is on, we are not hearing a lot about waterproofing, construction chemicals on, generally paints earnings calls these days. So is it that, the low-hanging fruit or the initial market share gains from traditional waterproofing players have come through and now, you're seeing broadly similar growth in those categories as you're seeing in decorative paints? Or is it only because of competitive, focus on decorative paints, it is not discussed anymore?
I don't know. But frankly speaking, as far as we are concerned, we see a much faster growth in the construction chemical waterproofing still continuing for us, and is likely to continue in the next 3-4 years. It is likely to continue at a faster clip. So as far as we are concerned, this category is growing at a faster pace.
Sure. Last bookkeeping question on the market share slide where you've shown you've just crossed 21% in 1Q FY26.
Yeah.
In numerator is your entire India business, decorative plus industrial, both combined?
That is right.
And denominator would comprise of, how many players? You've mentioned listed players. I assume
Five
you're not
players.
including.
So it is Asian, Kansai, Akzo Nobel, Indigo, and Berger. These are the 5 players which are there. And the denominator, this is the total standalone value of all of these players. And our value includes 2 companies, in addition to the standalone figures, which is STP, which operates out of India, and SBL Coatings, which is Sabu Coatings, which also operates within India only. So these are the 2 companies which adds up. And if you add up these standalone figure with these 2 companies, that's where our market share is.
Would the trend be broadly similar for decorative paints also? If you were to do the same exercise for decorative paints, same set of companies?
Yes, more or less. It will vary maybe 0.5, 0.6% here and there, but trend will be very similar.
That's it from my side. Thank you very much and good luck.
Thank you. Next question is from the line of Amit Purohit. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. Am I audible?
Yes, you are, Amit.
Yeah.
Go ahead.
Just on the growth trends, one, I wanted to understand, you clearly highlighted that you are doing not anything much. We are waiting for the things to happen, which is a natural progress that as the dealers realize that margins are less and velocity is low, they will come back. But I just want to understand within the incumbents, when I look at growth trends, this quarter has been slightly, we've seen the leader doing a relatively better versus its own performance, and our gap kind of narrowing. Would it be more because of the regional, or it would be more because of the products mix that would have led to this slightly gap in reducing? I know it's a quarter thing, but just wanted to have your thoughts.
No, it's, see, difficult to say for me, on this type of a situation. We have continued to do what we can do. What the leader does or what the gaps are, sometimes, they do well, sometimes they do little worse than us, so it's always, difficult for us to justify the gap increasing or decreasing, right? Sometimes, there are extraordinary events happening for them as well, so which can create, gaps which are higher. Sometimes it is not so, and it is normalized business, and then the gaps get narrower. So uh, nothing that I can comment on. It is not something which is within our control as well. We keep doing what we can do best, and I hope that we are ahead of the pack as far as the industry growth is concerned. Wherever it is, we should be ahead of that by at least 2.5%, and that's what we maintain.
Wow. And sir, second question on the industry growth itself. So you clearly highlighted that as the rain, season gets over, we expect the growth to come back. But I'm just trying to think about it on a YOY basis. Rains remain right in July, and since there is a demand is muted. Uh, uh, would would that be a point of a concern as we go ahead, or you think the base effects will probably help us, and hence the growth will improve? Because I understand Q2 onwards, the base for our industry growth started to become much more muted.
Yeah, so the base effect will help definitely in the third and the fourth quarter. Overall, that should be a positive for most of the players. Uh, but as far as the rains are concerned, it has been relatively heavier, and we expect that normally when it rains much more heavier than normal, the damage is also to the wall is much higher, so the demand tends to pick up after the rains abate. So we expect that uh, that there will be a good movement towards the second half of the year, coupled with relatively lower basis. The growth rate should pick up in the second half.
So thank you for the clarifications. Thanks a lot. All the best.
Thank you. We consider that as the last question for the day. I hand over the call to management for closing remarks.
So thank you all for coming and taking time out and attending to this meet. Wish you all the best. Thank you very much.
Thank you on behalf of MK Global Financial Services. That concludes this conference. Thank you for joining us.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.